Hello traders, so today I'm going to talk about how you can trade NFP. You know, the date today is the 20th of February, so in around 2 weeks we will have the next NFP. So as you guys know, it is the first Friday of every month, so the 4th of March will be the next NFP. But I'm going to go back over the last 3 or 4 NFPs to show you how you don't really need to know about the fundamentals to actually catch the moves. When we're actually trading news events, it's mainly based off liquidity. So price will set up liquidity areas beforehand for then NFP to grab those areas and then create the original move, which was intended in the first place. A lot of the times what you'll see is a fake out, or people call it a fake out, or a stop hunt for the first move of NFP, you know, the first 30 seconds, the first minute or so. This can usually happen. And a lot of people just say it's a fake out because it goes in one direction, a lot of pips, and then switches directions. And today I'm going to go through that. So 1:30 UTC time, so GMT, UK time. Make sure your trading view is actually set to this. So then when you're looking at the charts, you can see the same time zones that I'm actually looking at. So when you're like marking out New York session, it's 2 o'clock or 1400. London session, 8 AM, and they're the main ones you really need to know about. So firstly, what can we see here on gold? So as you see, this is at 1 o'clock. So this is right before NFP. So after this candle closed, like here, NFP actually happened. And how could you have caught this? So as we're expecting, the first move is always a fake out, most of the time. And there are many ways you could have actually caught this trade. You know, if we're starting off just using like the fib, if we change this to the 61, you see this imbalance across here. If we just draw this across, you see we hadn't tapped into the 61 yet. If we draw this across, boom, we've got the 61 in this area. And because we're expecting the news to actually create that fake out first, what we can see is where could price fake out to. So obviously we have this area to the upside here. Wick came down, wick came up. You know, this area, if you're looking at like fair value wise, so fair value gap's the gap which hasn't been filled yet, we could see this area. But also, if we're looking based on previous price, you know, we've kind of bottomed out in this area and we've kind of switched the trend. So if we're going to continue to the upside, like we are doing here, what can we see happen? Obviously I don't use the trend lines and I don't teach trend lines, but that was just to show you the direction of the market. So what we can see is this imbalance area here. And if we draw the fib across here, now we've got the 61. If we put the 70 on there as well, or like the 70, where is it? Let's change that to the 70. Black, there we go. So we've got that area there. Also, we had the bottom of this imbalance here, which is the New York low from the previous day. So this is where we're actually looking for price to come down to. And what you could do, you could sell from this area down to this fib, down to like the 70% or the 61% of the Fibonacci. The fib literally just measures the imbalance candle because, you know, we don't really want to fill 100%. If we do, that's when we go our entry off the order block, pretty much. But many confluences on this sell position here. So we have, you see this top of this order block here. London, this was the London high, new London high. And then we tapped into the top of the order block. We tapped into the 61. And now we're looking for price to drop down. You know, you could just wait for the buy positions. You could wait for the fake out first before actually entering NFP, because sometimes you do get a lot of volatility. You get higher spreads as soon as the news release actually does drop. But if we actually look here, first candle down, we tap in. But then look, first candle down at 1:30, we tap in. This is when most of the volume would have been. And in this area, the spreads probably would be wider. Say your spreads are usually 2 pips on gold, they've probably been 3 or 4 pips. So your entries would be a bit off if you are actually getting in on the trade. But look where we tapped into perfectly. Normally people would be like, oh, NFP selling, selling, selling. But look where we perfectly rejected into. So you got to realize that price doesn't just randomly come to these areas then reverse. You know, you can see that price came into this area for a reason. We're filling the 61, the 70% of this fib here. You know, we just missed this area down here, but that doesn't matter because that's why we use the fib entries, because we're measuring the percentage of the imbalance which we could see to actually get filled. And if we actually look now what happened, then price completely retraced to the upside and again rejected that 61. And what does it do when it's rejecting the 61? It's building liquidity, because if we have wicks, what people are doing in this area, well, they're selling. So now above here is their stop losses. So what can we see? Price then take the stop losses and then go up to the second area which we actually had marked. So if we actually get rid of this, you see this area which we had marked around here, that's where we got a bit of resistance, and then yeah, price then broke to the upside. But you see you could have still caught sales from here down. You know, there's still a decent amount of pips, you know, 70 pips or so, but the original move which I was actually focusing on in this video was this one here. So the move to this area, which was around 300 pips. And how many pips of drawdown would you have had? 15 pips. So you probably could have got away with, as you've probably seen recently, I have been using the 20 pip stop losses, so you would have got away with that perfectly and would have caught the move to the upside. You could have even caught the sells as well if you'd wanted to trade both ways of NFP. But yeah, if we look back to January now, where it's the NFP, so we look, the first 2 days were on the weekend, so we look down to the Friday the 7th. So now we go back to Friday the 7th of January, down here. So we go just before the NFP happened, and we can look what is happening in this area. So you guys can probably see what's going to happen with this one. So we had this key level here. What happens when there's a key level like this? Let me just make the line a bit darker. There you go. You should be able to see that now. You know, we've got wicks in the area. So what can we expect to see now? Well, we could expect to see, as you see, this is the candle before NFP. Actually, there we go. So what could we see happen? When there's wicks like this, what have I just said previously? Stop losses below the level. So what can we see happen? Those stop losses can then get taken. But why did it tap down into this level? You know, it looks like quite a random level, but if we actually look back here, what is there here? This order block. And you know what happens when there's an order block? Price comes in, tests the level, and then goes to the upside. So we have this order block in this area. You know, sometimes I know people say they don't usually, sometimes they won't get tagged in or when they're entering on the top or the bottom of the order block. So usually you could either use, I don't know, 50%, you can just draw the fib on these levels too. But if you draw the fib on this level, probably still would have been tapped in on either this one or the other ones. But if we actually extend this right, so we go into the settings and we extend right, this order block, perfect tap into it. Now we might not have hit the body. If we actually look across, the body probably would have missed by like a pip or so, depending on your broker. But where do we tap into? We tap perfectly into that order block. So the liquidity was below here. We tapped in, grabbed the liquidity, went to the upside, and then where could we target? Well, clearly we've got the first target, this area here. So this was where we had that big London wick. If we say this wick actually here, you could either target the top of this order block, which then broke the structure, top of this order block, even that broke the structure, or you could target the London high, which is in this area. So you've got these two targets. Also, what do we have across here? We have this order block technically been mitigated, but we also have this imbalance area. You could say this imbalance area because this one has actually kind of been filled fair value gap wise, and we've tried to come back into it. But higher time frame, this would just be one imbalance candle. But let's say this area here could be a target. So we've got our possible targets, and if we look, price came down. Again, a lot of the times you can get multiple different entries. Order block, came back, tapped the order block. How many pips drawdown would that have been? 21 pips. Perfect trade. Here you would have had minimal drawdown as well. Let's say you're just entering middle of the order block, 50% of the order block maybe. You still wouldn't have been stopped out. Then if we play price on, what have we now done? We've kind of broken out of this sort of zone. So if we draw like that, price came back, test the zone, and then we go to the upside, and look what happened at this area. If you missed the original entries, what can we do? Fib across, boom, you could have possibly got another entry. You know, let's see if it holds or not. There we go, holds perfectly. Both of the targets, which we could see hit, did actually hit. So this area here, 1, 2, 3 wicks in the area, drop down. You could have hedged the trading. That's when you buy and sell at the same time. So in buys from down here, you sell here while still holding these buys. You sell down to the fib, close out the sells, enter the buys for this second target, and then you're out of the trade. So then you're just maximizing your targets instead of just having one trade going, when you can still see possible places where you could enter the opposite direction. Then the second target was hit. If we play price on, we then go up and tap into the third target, and yeah, we get that nice little drop down. If we actually go on to December, so December would be the 3rd. If we actually go back now, 3rd of December, so the 3rd at 1:30 here. Very nice NFP, this one. It was quite different. So what can we see in terms of areas of interest? So we obviously have this area here. And why? You know, we had this order block was filled, multiple wicks in this area, so there is liquidity. Also, we could see, if we draw this across, imbalance hasn't quite tapped the 61% on the fib on this level. So we could see price go to the upside. But now we look to the downside, because if our bias is price moving to the upside, what can we see downside wise to get manipulated first before creating a move to the upside? So we have this area here, holding control, and it locks on. So we locked onto the body there, and this could be an area where we could see price tap into before moving to the upside. So we also have this area down here, which obviously would give us a better risk reward, but it would be quite a big wick down to actually tag us in on this trade. But we can see what happens. So these areas are the possible entries, and also we could draw an imbalance fib. This area across, you see you wouldn't really use the whole area because we've got many order blocks in between, and they have kind of been filled. So we look at this area here, look what price does, taps into this bottom area. Could have got the fib entry, could have got the order block, bottom of the order block entry. And let's see if price holds. We get another tap and another tap in this area. So 4 or 5 taps on the fib. You got 3 taps on this bottom order block. So you kind of had an hour and a half, 2 hours of price in the area to actually get your entries, even if you missed them. Another tap, and then we get that push to the upside. And where does price go to? Just before this liquidity area. If we play price on even further, what can we see happen? Consolidation, and then price moves to the upside. And let's see if it rejects the fib. Not quite yet. But yeah, this is a lot of consolidation. And you know, after the NFP, let's say you got your entries down here. Let's use the risk reward for this one. And remember I said how many pips I use for the stop losses? 20 pips now on gold. You know, you can use 30, but I found with this strategy that I actually teach, you can get a lot better risk to rewards wise actually using a 20 pip stop loss. Let's say you catch 150 pips with a 30 pip stop loss, that'd be 5%. With a 20 pip stop loss, you know, it'd be just under 8% risk to reward. And you see how this one would have been a 1 to 10. You know, there are possible extra entries. So if you draw the imbalance fib across here, this candle, and you're probably asking, why didn't you do this candle as well? If you look across, been filled, created liquidity in this area, what needed to be grabbed, boom, grabbed it, and why did price come down to this area in particular, into the fib, boom, to the upside, and hit our liquidity target. And as you see, remember that grey box I've marked out? What was in the area? New York high. If we draw that across, what happened to that New York high? Boom, gone. Price dropped down from that area, and you could have caught the NFP again. So this is how I caught last NFPs and how I actually predicted them. You guys know I send all the charts and stuff in the group when I actually trade the NFPs, you know, the profits and stuff. But yeah, I might do a live trading NFP if you guys are up for that. But yeah, I hope this did help you guys, and if you have any questions, be sure to ask them in the Discord.